LiteFinance, the world of financial freedom.
Hello, it's Monday, February 21st. We are starting the market forecast, and let's talk about what is worth paying attention to during this week, because apart from the potential conflict itself, which probably won't happen, there are a few issues worth mentioning as well. So as far as the media are concerned, we are constantly bombarded with information about the future phone calls and planned meetings between governments to de-escalate these growing tensions between Russia and the US over the war in Ukraine. Additionally, Bloomberg is sending in their newsletter this kind of articles, so it is natural that fear grows. The goal of all of this may be to try to destabilize the region's raw materials supply chains and expand US influence in the oil and gas market. When it comes to the oil itself, the US has become the largest producer in the meantime, and prices are constantly rising due to the good economic situation in the world, which translates into a considerable demand, which so far has not been followed by supply. So high market prices are an opportunity for the US because naturally oil or gas from North America are more expensive due to the transport costs, while the current situation is favorable for purchases of US crude oil. In another video, I talked about how the OPEC Plus countries are far from achieving output at the level they have set their targets. So looking at the situation from this side, it starts to make sense. An additional factor that may cause a market pullback is of course the situation with Iran and the endless talks on nuclear weapons and the lifting of sanctions. In the long run, this should not be threaten long-term growth of the price of the oil, but as I mentioned, some single pullbacks could be caused by it. Another issue is, of course, the hawkish Fed, the comments of which we received in the last minute's publication of the FOMC meeting, which show that an even faster and larger series of hikes than in 2015 are planned. Another important news comes from Australia, which opens borders after 2 years, which could be on a rising tide if they keep extracting raw materials and not shut down the economy. The demand for raw materials is large, which can already be seen in the valuations of Australian mining companies, and which may also help the Australian dollar. Along with the demand for Australian goods, the demand for Aussie dollar will most likely follow. Let's move on to the calendar. Today the USA and Canada have a day off, so it may be a good day for EURUSD, for example, which is gaining on hopes for a peaceful resolution of this dispute. Today we have already received the first PMI readings from Germany and the UK. Slightly worse than previous ones and slightly worse than expected as for the Germany. On Tuesday, economic sentiment data from IFO from Germany, and in the afternoon the US Consumer Confidence Index, which is one of the leading macro indicators which we also talked about on this channel previously. Wednesday's decision on interest rates from New Zealand, which will most likely raise interest rates again. As for Kiwi, however, I would look for a short opportunity. Now we are at the upper end of the megaphone formation, and we are waiting for the formation of the fifth wave, which in this case will be in the downward movement. So that is why I marked this level of 66 and 10 for observation for this week. During the day, we will also receive data on inflation in the Eurozone, and a meeting on inflation reports in the UK will be held as well. On Thursday, the governor of Bank of England, Bailey, has a speech scheduled during which the data on the preliminary reading of the US GDP will be released. In addition, numbers on initial jobless claims, new real estate sales, and several FOMC members later during the day have scheduled speeches, namely Bostich, Mester, and Peel. On Friday, we will receive revised GDP data from the Germany, US core durable goods orders, and a monetary policy report for the evening. Now let's move on to some charts. Let's start with the Euro USD. We have this sloping sideways channel, and still the right shoulder of the formation wasn't finished. I would try to go long on any pullback toward the lower boundary of this channel like we have it right now, for example. Additionally, the upper boundary and 61.8 FIBO level are in the close range, so until we see those levels broken, the sideways move most likely will continue. Next is gold. We need to break through $1,900 level and then 61.8 FIBO level to see continuation to the upside. As we can see, the price started to consolidate just below the psychological level. Any of the signals that we will get a pullback of a breaking or a breaking move to the upside, I would take as an entry signal in either direction. Lastly, Brent oil. Still the same approach as last week. I will trade any pullback to those strong levels. As we saw recently, it paid off. It might be not too late to enter in long, since we might just broke out of this flag pattern that would signal us at a continuation. Okay, that is all for today. Thank you, and I'll see you next time.